Now we're going to look at mortgage loans. So the objective of this session will be able to examine the various approaches to pricing and structuring fixed interest rate mortgage loans. We'll also be able to look at pricing, which refers to the rate of interest, fees, and other terms that lenders offer and that borrowers are willing to accept when mortgage loans are made. First, we're going to have a brief overview of the determinants of mortgage interest rates. So the mortgage rate of interest on mortgage loans is established by what borrowers are willing to pay for the use of funds over a specified period of time and what lenders are willing to accept in the way of compensation for the use of the funds. So hereby demand is driven by the demand of real estate and supply is pegged on the return to risk considerations. Now let's look at interest rate and inflation expectations. These are some of the determinants of mortgage interest rates. So real rate of interest is the minimum interest rate that must be earned by savers to induce them to divert the use of resources or funds from present consumption to future consumption. Nominal interest rate on any investment is partially determined by the real interest rate plus a premium for the expected rate of inflation. This can be explained through the following formula. 1 plus nominal rate is equals to 1 plus the real rate times 1 plus inflation rate. Let's look at interest rate and risk. In addition to inflation, lenders are also concerned about various risks undertaken when making loans and investments. We have default risk. This is the risk that borrowers will default on obligations to repay interest and principal. Interest rate risk. This is the uncertainty about what interest rate to charge when a loan is made. We also have repayment risk. This is the risk that loan will be repaid when interest rates fall below the contract rate. We also have liquidity risk. Securities that can be easily sold and resold in well-established markets will require lower premiums than those that are more difficult to sell. We also have legislative risk. This refers to changes in regulatory environment in which markets operate. For example, laws affecting interest rates. So another thing for us to be able to note is accrual rate is the periodic interest rate. So in the future, once we come about this term, simply means the rate divided by the number of periods of which the particular loan or the investment is compounding. So now let's look at what is the relationship between accrual rate and loan payment for a given period of time. So here we have a type of constant payment mortgage loans. So the constant payment mortgage loan can either be fully amortizing, partially amortizing, interest rate only, or negative amortizing. For fully amortizing constant payment mortgage loan, the payment rate is greater than the accrual rate. This means that the loan balance at maturity will be fully repaid. For partially amortizing constant payment mortgage loans, the payment rate is greater than the accrual rate. This hence means that the loan balance at maturity will not fully be repaid. Interest rate only constant payment mortgage loans, on the other hand, usually the pay rate is equal to the accrual rate, which means at the maturity date, the loan balance will be equal to the amount borrowed. We also have negative amortizing constant payment mortgage loans. Here, the payment rate will be less than the accrual rate. And by this, at the maturity of the loan balance will be greater than the amount borrowed. For us to have a clear understanding of the constant payment mortgage loans, different implications, we'll be able to do this through this practical example on Excel. Now let's look at a practical example. We'll consider a mortgage loan of 60,000 Kenya shillings at an interest rate of 12% payable annually for 5 years. Prepare the loan amortization for a fully amortizing constant payment mortgage loan. So once you open Excel, let's first note the loan amount. So in this case, we have 60,000 and the interest here, the interest rate is 12%, is 0.12. Then we also have the loan term. In our case, it's 5 years. Now, first thing we need to calculate here is the monthly repayments. Oh, not the monthly repayment, but the annual repayment, since it's payable annually. So for us to get the annual repayments, we'll use the following formula. It's equals to PMT into brackets, take the rate, then comma, number of periods, comma, then the present value, which in this case is the loan amount. And then with that, close the brackets and press enter. So you can see the amount here is a negative, this meaning a negative cash flow. So for the purposes of this example, let's just leave it as a number. And then you can also multiply this by a negative one to make it positive first, just for the purpose of this example. So from amortization table, what we first need to note, we need to create is the years. So here we have 5 years. So with that, you can simply highlight and drag 5 years. Then we have the annual payments. Which in this case will be equal to these annual payments, which we've calculated here. So you can simply lock in this and drag it down so that it remains constant. Then another important thing to note is the interest payment. Since this amount here the annual payment is inclusive both the interest and the principal. So for you to get the interest payment, it's simply the loan times the annual interest rate. That's the interest the first year. And the principal, this is actually the amount which goes back to repaying the loan. It's usually calculated by subtracting the interest from the annual payment, or rather from the repayment for that particular period. So that's our principal. And then finally, you need to calculate the balance. So in this case, balance is equals to the loan amount, or even to make it easier, let's just proceed the way it is. We take the loan amount and less the principal payment. So that's the loan balance. Okay, for the second year, for us to be able to get this particular interest rate, now again, we have our interest rate, but in this case, since it's a reducing balance, we multiply it by the previous balance, not the initial 60,000. So multiply it by that. That's the interest. Now for the principal, you get it by subtracting again the interest payment from the annual payment. And our balance in this case will take this balance and we less the principal which has been paid. Now, since we're using Excel, we need to think of a way of making our work easier, because in some cases you can find you're working with so many periods here. So you should be able to structure the formulas in such a way that you can easily drag them down and get our answer. So since here I already locked in the interest and I multiplied it by the last balance. So if I drag this down, the formula will hold. Then for the principal, I simply took the annual payment at that period and subtracted the interest. So with this formula, if I drag this down, that will also hold. Now for my balance, the balance up here, I simply subtracted this, the earlier balance, less the principal. So we also drag this down, it should hold. So you'll realize at the end of the period, you will have fully repaid the loan. So the balance will be 0. So that solves the first part of the problem, where we're looking at a fully amortizing constant payment loan. So for the next example, let's look at a partial amortizing constant payment mortgage loan if the desired balance at the end of the 5 years is 40,000 Kenya shillings. So in this case, we still again note the loan amount, which is 60,000. Then we also note the interest rate, which is still 12%. The period, loan term, is still 5 years. But now we want a future value, or rather remaining with 40,000, which here is a future value, 40,000, which is at the end of these 5 years. So in such a case, our monthly repayment formula would be as follows, or rather our annual repayment. So we'll take is equals to EMT, take the rate, comma, the period, which is the loan term, comma, our present value, which is 60,000, comma, but also in this case now, we also add our future value. Then close the brackets and press enter. So for our case now, the annual payments will be 22,940. Now for the purpose of this example, let's change this from currency to number, and let's also multiply it by a negative. Make it easier for us to work with. So this is the annual repayments. So let us create the amortization table. Yes, so to make your work easier, the amortization table, you can also start with 0 and then drag it down to the end of the period. Then we have our annual repayment, interest amount, also note the principal, and finally the balance. So at time 0, where we are starting, the loan balance is in full, which is the 60,000. Now the annual repayments at the end of the first year, this will be equal to this amount which we had calculated earlier on here. So let's just lock that in and drag it down. So this is the annual repayment during this period. The interest amount for this first year will take our interest rate multiplied. Let's also lock this in. We multiply this by the loan balance. Press enter. And then for us to get our principal, we still subtract the interest from the annual payment. And for us to calculate the balance, we just take the amount up here less the principal amount. Now, with that being said, you can simply highlight this and drag it down to the end. So now you'll realize at the end of this period, we have a balance of 40. So there's a mistake here. So the mistake, you can realize that according to a formula, this future value should have been a negative. This means that now for us to be able to calculate the amount, so we end up with a balance of 40,000 Kenya shillings. So in the other case, if we left it as a positive, it meant that we ended up with a negative balance, which doesn't make any sense when you think about it. So for such an example, our future value here is a negative cash flow. Now let us consider an interest only constant payment mortgage loan. So where in this case the repayment is only for the interest. So now let us create an amortization table for this. So let's note the loan amount, which is still 60,000. You also need to note the interest, which is 12%. Then the loan term, which is 5 years. So for this case, our monthly repayments won't be calculated as we had done in the previous examples, since it only entails payment of the interest. So now here we simply calculate the interest payment, which in this case will be this amount multiplied by the loan amount. So for the amortization period, let's create it down here. So we have the years. So let's start again with 0, 1, 2, and simply drag it down up to 5 years. And then we have the monthly repayments. Interest, principal, and the balance. So for interest only loan, this means that for each monthly repayment, you're only paying the interest amount. So this will be equal to this. Let's just lock that in and drag it down. So this is also the interest which is being paid. So let's simply drag that down also. So the principal amount is 0. So which means the loan balance will continuously be 0 throughout this particular period of time. So here you realize that you'll only be paying the interest amount and not paying anything on the principal. So at the end of the loan term, your loan balance will still remain the same as you had earlier begun. Now let's look at an example where we have a negative amortizing constant payment mortgage if the desired balance at the end of the 5 years is 80,000 Kenyan shillings. So for this, let's go back to Excel. Note the loan amount. So for a case here, still 60,000. Also note the interest, which is 12%. We also need to note period, which is the loan term, which is 5 years, and the future value, which will be 80,000. So we put it as a negative. So for this, we can calculate the annual payments. So we'll use the following formula. Is equals to PMT. Let's take the rate, then number of periods, and then the present value, then the future value, and close those brackets and press enter. So that's the annual repayments. So to make it easier to understand, just add a negative in front of the formula for us to get the amount. So then proceed to create the amortization table. So here we have the years. So when starting year 1, year 2, let's drag it down to 5. Then the repayments, which in this case will be equal to this. Let's just lock it in. Drag it down. Then we have our interest. Also note for the 0, which is the starting point, you don't have any repayment for that period because the payments are being done at the end of each year. Then we have the interest. Principal and balance. So for this balance is the loan amount. For the interest, we simply take our interest here, which is the interest rate, times the loan balance. And for the principal, we take the repayment and less the interest. And for the loan balance, you take the balance less the principal. So in such a scenario, you realize that the principal amount is a negative on each repayment. That's what causes the future value to increase. So we can highlight that and drag it down up to the end of the 5 years. So now you can easily see that at the end of the 5 years, we'll have a loan balance of 80,000 Kenyan shillings based on this calculation. So the advantages of having an amortization table is that you can be able to easily identify the loan balance at the end of each period. So for example, if we needed to find the loan balance at the end of 2 years, assuming the fully amortizing constant payment mortgage. So in this case, that amount will be equal to 39,977.48. So this is the amount at the end of the 2 years. So another way, in the event that you don't have the amortization table ready, another way to calculate this will be the present value of the annual payments for the remainder of this particular period. So for example, in our case here, this will be the present value of, check the rate, number of periods. Since it's at the end of the 2 years, you have 3 more years. So a period here will be 3. And our monthly payments in this case will still remain this, and simply close the brackets. So you find this amount is equals to this. So depending on what you have for information on calculation, if you find that creating the amortization table will take you time, this is how you're supposed to reason out the calculation of the loan balance at any particular period in time. When it comes to practical mortgage loans, or rather market practices within the mortgage industry, we also have loan closing costs. So some of these include the loan origination fees. These are charges to cover expenses incurred by the lender for processing the loan. You also have loan discount fees. This charge represents an additional finance charge, but its primary purpose is to adjust the yield on a mortgage loan. So let's look at a relationship between yield and time. Effective interest rate on mortgage will always be equal to the contract rate of interest when no finance charges are made at the time of loan origination. If the loan origination fees are charged to the borrower, the following occurs. The effective yield will be higher than the contract rate of interest. The yield will increase as repayment occurs sooner in the life of the mortgage. So let's have a practical example for us to be able to clearly understand this. So assume the contractual loan amount is 60,000 Kenya shillings. Then we have to less origination fees of 3%. And from there, we also calculate the net cash disbursed by the lender. So for us to get this, we'll subtract the calculated loan amount less the origination fees. The amount to be repaid per year will be based on the contractual loan amount and not the net cash disbursed by the lender. So based on the 60,000 loan for 5 years at interest rate at 12%. So now let's try and get the yield with the loan with origination fees. So for this example, our loan is 60,000 and the origination fees is 3%. So first, let's note the loan amount, which is 60,000. Our interest is still 12%, and the loan term is 5 years. So what's our monthly repayment, or rather our annual repayment? So this is equals to PMT, take the rate, comma, number of periods, comma, and the present value, comma. Then press enter. So this the annual repayment, 16,684. So however, since our loan amount was 60,000, the loan origination fees were 3%. This was 3% of the loan amount, which is 1,800. So which means the disbursed loan is actually 60,000 less the 1,800. So this is the actual amount you should get in your pocket and not the 60,000, which was earlier assumed to be your the amount which you had applied for as a loan. So for us to get the monthly repayments, there's something important here which we need to do. So earlier you could have realized I simply added a negative here. That was to make my annual payments be a negative. So if I remove this negative, you'll notice that the annual payment is indicated as a negative cash flow. So this means that if you take it this way, when you apply for the loan, that's a positive cash flow. If you are repaying the loan, you have a negative cash flow. So for us to be able to calculate the internal rate of return, we need to look at which interest would have applied if you're actually being disbursed for this amount of money, 58,200, and still repaying this amount of money. So what's the effective yield, or rather the internal rate of return, since it will obviously not be this 12%, since this amount is lower than the 60,000. So for us to calculate this, so let's calculate our internal rate of return. So is equals to rate into brackets. So take the number of periods, which is the 5 years, the repayments, which is this amount here, and in this case now our disbursed loan, which is this amount right there, and then close the brackets. So you realize that our internal rate of return now is 13.24%, and not the 12%, which was earlier indicated when borrowing the loan. Now let's look at another example where we calculate the yield with early repayment. So we still work with a similar example, but in this case, there's an early repayment of the loan balance at the end of 3 years. So we'll still reduce the loan origination fees of 3% and proceed to calculate the internal rate of return when the loan balance is paid off at the end of 3 years. So for us to be able to do this, let's go into Excel and do it practically. So let's again note the loan amount, which is 60,000, the interest, which is 12%, loan term still remains to be 5, and let's calculate the annual repayments. So this is equals to PMT. Let's get the rate, total number of periods, and the present value. Let's leave it in number format. So the annual repayments in this case are 16,644. Okay, so we also need to calculate what is actually issued to the client. So the loan is 60,000. The origination fees 3%, which is equals multiplied by the loan amount. So the disbursed loan, we just less the origination fees from the loan amount. So that's the disbursed loan. So another important thing here is early repayment. So early repayment at the end of the third year. So this means that the client clears the balance at the end of the third year. So for us to get the balance, it's good for us to create an amortization table to clearly indicate this. So at the beginning of the loan, the client has a loan of 60,000 Kenya shillings, but the repayments are this constant here. So for the purpose of this example, let's put it in a negative format for it to assist us maintain consistency in our table. So the repayment is 16,000. The interest is still calculated as percentage of this balance here. So for the interest, simply log that. And you multiply it by the loan balance. Then for the principal, simply less the interest from the repayments. And for our balance, we take the balance less the principal. That being said, you can simply drag it to the bottom. Now you have your amortization table. But based on this example, at the end of 3 years, the client wants to repay this amount. So when you think of this in terms of cash flows, so let's have the year and cash flows. So at the start of the period, the client receives 58,200 and not the 60,000. So there we have 58,100. Now from year 1, 2, and 3, the client pays the monthly repayment, which in our case was this amount here. So this amount was paid on year 1, 2, and 3. But on year 3, the client paid the annual repayment and also cleared this particular balance. So in this case, the cash flow will be this, and they'll also less this. So the total cash flow at year 3 is this amount, 44,774.78. So for year 4 and 5, there'll be 0 cash flows. Okay. So now, based on this example, we're trying to get the effective rate in such scenario. So for us to do this, we'll use the formula IRR. So this will take into account all these particular cash flows. Then we can give it a rough guess. Let's say 0.1 or 10%. Close brackets, press enter. So in this example now, our effective yield, now this is our effective yield or IRR, it's actually increased to 3.51% from the previous amount, which was 13.24%. So now this is the effect of early repayments. So early repayments effectively increase your yield or your internal rate of return, and also loan origination fees also increase your effective interest rate which you pay on the loan. In some cases, we also have a scenario whereby in the event of early repayment, there's usually a penalty which is charged, and this penalty is often calculated as a percentage of the loan balance at that particular period of time. So going with the early example, where the early repayment happened at the end of the third year, assume that there's a repayment penalty of 3%. So let us calculate the internal rate of return. So with this, let's simply copy this into a new sheet and proceed to calculate it. So since every factor is being held constant, so what will happen here? So there's an early repayment of 3 years. You also need to note there's a repayment penalty of 3% on loan balance. So again, let's look at these particular cash flows. So we have the year and we have the amount. So for year 0, or at the start date, the bank disburses a loan of 58,200. Now, for the first year and the second year, you're only paying this loan amount, which is this amount right here, is equals to that amount, the 16,644. Again, for the second year, you're still paying that amount. But now, for the third year, there's a repayment penalty of 3% on the loan balance. So for us to get this amount, this is 0.03 multiplied by the loan balance at this particular period of time, which is 28,130. So this is the repayment penalty of 3%. This amount will also be incurred at the end of the third year. So let's get the total amount which is incurred at this particular period in time. So you will take the annual payment, and also you'll have the repayment penalty, and then the loan balance which you're particularly clearing at this period in time. So that's the cash flow for that particular period of time, the end of the third year. So for the fourth year, it will be 0, 5 year will be 0. Now we want to get our internal rate of return for the effective yield. Now for that, use the formula is equals to IRR and highlight all these cash flows and give it a guess, let's say 10%. Then press enter. Then we can add the decimal places for us to get a clear view. So you realize that the internal rate of return has also increased in the event that there's a repayment penalty of 3%. So this shows you the effective yield or the effective rate on your end as the mortgage, or rather as the loan borrower, in the event you incur these extra charges or pay your loan before the due date. We earlier looked at constant payment mortgage loans. In some cases, you also have constant amortizing mortgage loans. So the payment on constant amortizing mortgage loans are determined by dividing the loan balance by loan repayment period. So for example, let's consider a loan amount of 60,000 Kenya shillings or $60,000 with a loan repayment period of 5 years, which is a constant amortizing mortgage loan. And let us generate the amortization table for this case. So here we need to do this in Excel by first noting the loan amount. So our loan amount here is 60,000 Kenya shillings. Now we also have an interest, and the interest rate is still 12%. The repayment period or loan term is 5 years. Now for this case, we won't calculate the monthly repayments by considering the present value, since this is a constant amortizing loan. So, or rather constant amortization amount. So the constant amortization amount will simply divide the loan by the loan term. So it means each year you're reducing the principal by 12,000 in such a way that at the end of the 5 years, you will have completed repaying this loan. So let us indicate this practically in terms of the cash flows, how they go. So we have the years here, 0 up to 5. Then we also need to get the monthly repayment. We also need to calculate the interest amount, the principal, and the loan balance. In this case, when beginning, we have a loan of 60,000 Kenya shillings. At the end of the first year, through the end of the 5 years, we will be reducing this loan balance by 12,000 Kenya shillings, since it's a constant amortizing mortgage. So for this case, this will be equal to the 12,000. Let's lock this. And drag it down the whole loan period. So the loan balance, we simply take this loan amount and less principal. So you find at the end of the 5 years, you will have completed repaying this loan. But what's important for you to also note is that you're still paying an interest for this particular loan. So at the end of the first year, you will be charged an interest. Let's lock this of 12% on the loan balance, which was at the beginning of that period. So in this case, for the first year, it is 60,000. Now let's press enter. However, during the second year through to the fifth year, interest is being charged at the end based on the balance on the previous period. So let's say for the second year, you're being charged an interest on the balance, which was 48,000 in the earlier case. Now the monthly repayments won't be constant, since we'll add the interest amount and the principal amount. Then you can simply drag this down. So this means that for the first year, your monthly contribution or your monthly payment will be 19,200. This amount will continue reducing over time, since the interest payment is also reducing over time. But how at the end of the loan term, you will have cleared the loan balance, since this is a constant amortizing mortgage loan. With that being done, now we've come to the end of this chapter on mortgage loans. You can attempt the quiz here below to further enhance your skills, which you've been able to gain from this particular course. Next, we look at adjustable and floating rate mortgage loans.